Have you seen the news? A staggering $70 billion just flooded into Bitcoin. This isn't a drill. It's a monumental shift in the financial world. But what does this massive wave of cash actually mean for Bitcoin? And more importantly, for you? Let's break it down. First, where did this mountain of money come from? The main drivers are the new Bitcoin spot ETFs. Think of these as a simple way for big money players to buy Bitcoin without the hassle of managing private keys or setting up crypto wallets. Giant financial institutions like BlackRock and Fidelity have rolled out these products, and the response has been explosive. As of the fourth quarter of 2025, their combined assets under management have skyrocketed to over $70 billion. We're seeing record-breaking daily inflows, sometimes billions in a single day. This isn't retail FOMO. This is Wall Street making a serious calculated move into crypto. So the big question, what happens next? The immediate effect is a classic case of supply and demand. There's a finite supply of Bitcoin. Only 21 million will ever exist. With these ETFs buying up huge amounts of BTC daily, it creates what's called a supply shock. The demand is suddenly far outstripping the available supply on exchanges. Basic economics tells us that when demand surges and supply is tight, the price tends to go up. A lot. We're not just talking about a small bump. We're talking about a fundamental repricing of the asset. This institutional rush also has a powerful psychological effect. For years, Bitcoin was dismissed by many in traditional finance as a fringe, speculative asset. Now, with household names like BlackRock putting their stamp of approval on it, the narrative has completely changed. Bitcoin is being legitimized on the world stage. This reduces the perceived risk for everyone, from large pension funds down to individual investors. It's a green light that signals Bitcoin is here to stay. This newfound credibility attracts even more capital, creating a powerful feedback loop. Looking at historical parallels can give us clues. Consider what happened when the first gold ETF, GLD, was launched back in 2004. Before the ETF, buying gold was cumbersome. After the ETF, a flood of new capital poured in, and the price of gold went on a multi-year bull run, increasing by over 300%. Many analysts are now saying that Bitcoin is having its gold ETF moment, but on a much larger digitally accelerated scale. The accessibility and global nature of Bitcoin could make this impact even more dramatic. But what about the risks? We have to be realistic. This massive influx of institutional money could also bring increased volatility in the short term. Big players make big moves, and their trading strategies could cause significant price swings. Furthermore, this brings Bitcoin more directly into the regulatory spotlight. Governments around the world are now paying very close attention. Future regulations could either help or hinder the market, creating an element of uncertainty we all need to watch. So, what's the takeaway from all this? The arrival of $70 billion via ETFs is more than just a headline. It's a landmark event that has permanently altered the landscape for Bitcoin. It signals a maturation of the asset, a massive reduction in supply, and a powerful validation from the heart of the traditional financial system. While the path ahead will surely have its twists and turns, the long-term trend appears to be set. The institutional era of Bitcoin has truly begun. What happens next will be one of the most fascinating stories in finance to watch. Thanks for tuning in. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our next update. See you in the next video.